One number explains why silver traders get nervous during tight markets. 50 to 1. Not the gold to silver ratio, the claims to cash ratio some analysts calculate when paper promises in futures markets tower over the metal that's actually ready for delivery. And here's the point. When that ratio spikes, the spot price can stop behaving like a real price and start acting like a placeholder. Today, we're walking through what happens when the silver market enters a stress test weekend. Systems pause, liquidity thins out, headlines get loud, and the physical market starts whispering a very different story than the paper market. Whenever you see talk of exchange systems going into maintenance windows, registered inventory drifting lower, physical premiums widening, and lease rates jumping, it creates a simple fear across the market. If too many people ask for the same bar at the same time, who gets paid and who gets paid out? Because in modern commodities, a lot of investors don't own metal. They own exposure, a claim, or a promise. And in calm markets, that's fine. But in stressed markets, promises get rewritten with fine print. Let's break this into 4 easy pieces. Step 1. Registered versus eligible silver. In COMEX-style reporting, you'll often see 2 categories. Eligible, metal in approved vaults that could be delivered but isn't currently assigned for delivery. Registered, metal that is tagged and available for delivery against contracts. So when people say deliverable supply is falling, they usually mean registered. Step 2. Open interest is not inventory. Open interest reflects how many contracts are outstanding. It's normal for paper volume to exceed physical inventory. Commodities use futures for hedging. But stress happens when deliverable metal shrinks while paper claims stay huge. A simple illustrative example, not a live quote. If registered silver is 40 million ounces and futures exposure implies claims of 4 billion ounces, that's 100 paper ounces for every 1 deliverable ounce. Even if only a small fraction demand delivery, the system can feel pressure. Step 3. Lease rates equals rent for metal. Lease rates are essentially what institutions may pay to borrow physical metal short-term. When those rates rise sharply, it can imply metal is harder to source, lenders are demanding more compensation, and short-term availability is tight. That doesn't guarantee a squeeze, but it's a signal professionals watch. ETFs and cash settlement risk. Many retail investors get silver exposure through ETFs, pooled accounts, custodial programs, or retirement wrappers. Some of these structures include clauses that allow cash settlement under extreme conditions, meaning you might get dollars instead of metal, exactly when the whole debate is about whether dollars can buy the metal at the displayed price. Now let's connect the chain reaction. Cause A. Industrial demand stays firm. Silver demand isn't only coin buyers. It's also solar manufacturing, electronics, grid infrastructure, medical applications, and high-spec components. When industry needs stable supply, it often pays up for reliability, especially if lead times stretch. Effect, physical availability tightens and premiums can widen even if the screen price looks calm. Cause B. Supply disruptions or export controls. Any hint of export restrictions, refinery bottlenecks, or trade friction can reduce the metal that normally flows into the global market. Effect, Western buyers compete for fewer sources, and the cost of sourcing physical metal rises. Cause C. Paper positioning gets crowded. If too many traders are on the same side, especially with leverage, then a sudden move can trigger stop-loss cascades, margin calls, forced buybacks. Effect, price gaps higher or lower faster than people expect because liquidity evaporates at the worst moment. Even if you're not trying to trade silver, there are legitimate opportunities in understanding this. Better market awareness. When you can read inventory reports, lease rates, and physical premiums, you stop relying on headlines. Portfolio stress testing. Silver episodes teach a broader lesson. Counterparty exposure matters in metals, in ETFs, in broker accounts, and even in some cash-like products. Temporary dislocations. Sometimes the opportunity isn't silver to the moon. It's simply recognizing when physical premiums detach from spot, spreads widen, and liquidity is thin, and avoiding bad decisions made in panic. Now the warnings, because this is where people get hurt. Volatility risk. Silver can move violently in both directions. Leverage risk. Futures and margin accounts can trigger margin calls quickly. A right idea can still bankrupt you if timing and leverage are wrong. Counterparty risk. If your exposure relies on a custodian, clearing member, or product structure, outcomes can change under stress. Liquidity risk. In fast markets, you may not get filled near the price you see. Premium trap. Physical can become expensive fast. Paying extreme premiums can lock in a loss if the spread normalizes. Fraud or counterfeit risk. In shortages, scams increase. Verification matters. Silver is not a savings account. It's a market. Think of the silver market like a concert with 10,000 tickets sold, but only 1,000 seats that are actually guaranteed. Most people don't show up at the same time, so the venue gets away with it. But if a rumor spreads that the doors might close early, suddenly everyone rushes in at once. And the bouncer doesn't argue philosophy. The bouncer just says, cash refund or no entry. That's paper versus physical in plain English. Silver stress often shows up when the world is dealing with sticky inflation or inflation volatility, geopolitical fragmentation and strategic commodities thinking, reshoring of supply chains, heavy infrastructure spending, and energy transition demand. In that environment, nations and industries care less about efficient global sourcing and more about secure sourcing. And secure sourcing usually costs more. That macro shift is why silver headlines keep returning. Here are 4 practical moves. Educational, not personal advice. 1. Audit what you actually own. If you hold silver through an ETF, pooled account, or retirement vehicle, read the prospectus or custody terms. Look for language around cash settlement, redemption limits, and authorized participants. 2. Reduce fragility before volatility. If your position depends on leverage or short-term funding, consider whether you're built to survive a weekend gap. In commodities, survival greater than being right. 3. Track the right indicators. Weekly habit. Add these to your routine. Exchange warehouse reports, registered versus eligible, CFTC commitment of traders positioning, lease rates or forward rates where available, and physical premiums at multiple reputable dealers, not just one screenshot. 4. If you buy physical, prioritize verification and liquidity realistically. Don't turn risk management into panic buying at any price. Everything we discussed is based on how commodity plumbing works and what professionals track. Exchange warehouse categories, regulator positioning reports, bullion lending signals, and documented precedents like the LME nickel disruption where paper mechanics collided with physical constraints. The goal is not to scare you, it's to make sure you're not operating blind while others read the fine print. This video is for education and market commentary only, not financial, legal, or tax advice. Commodities and precious metals can be highly volatile, and leverage can magnify losses. Past market dislocations don't guarantee future outcomes. Always do your own research, understand product terms, and consider speaking with a qualified professional before making investment decisions.